Hello there and welcome to the last Commodities Corner of the week. Now, we're only days away from the latest monetary policy meeting by the Federal Reserve, but already investors are positioning themselves in hard assets such as gold and silver, over fears that the enjoyable multi-billion-dollar bond buying program the Fed has used to help the markets so far could finally be coming to a slow but definite end. We've heard this before, of course, but next week's meeting, some analysts believe, could actually provide a much clearer picture of just how so-called tapering might look in 2014. Well, joining me on the line from London is commodities market analyst Alistair McCaig. Mr. McCaig, thanks for joining me today. Gold and silver have recently hit 3-week highs. Are investors panicking, do you think?
Well, I think when it comes to gold specifically, and to a lesser extent silver, it is very much a sort of sentiment-driven trade, as opposed to so many other vehicles out there with which traders tend to use their head rather than their hearts quite so much. And we've seen in the last couple of weeks a spike back up to that sort of 1268 level, which was the high, and that lasted the best part of a day or an afternoon even before the sellers came back in. I think the battle that gold has is well known, that it's well embedded in a negative trend, and certainly over the course of this year we've seen the worst performance in gold since back in 1981, and year to date we're down roughly about 25.7%. So it's going to have to battle pretty hard to break out of that negative trend. And when you consider some of the factors that have gone on this year, that catalysts that potentially could have seen gold buck that trend and revert back into a more bullish mindset, the looming possibility of war in the Mediterranean with the events that went on in Syria really does cause questions to be asked to say, if that can't be a good enough catalyst to break that trend, what would be needed to see the sort of flight to security status of gold really being fully utilized by the investment community.
One analyst recently told me the biggest threat to financial markets in 2014 is not Fed tapering and a repeat of this spring. It's in the price and minds of market participants. Well, if we know the Fed is likely to draw out this process and not let it go from $85 billion to zero, why did gold delivery for February rise to 2.2%?
Well, I think that there are other aspects when it comes to gold. We are reaching that sort of 1,200 level where we're only sort of as we speak mid-morning on Thursday. We're trading about 1243 at the moment, and we're only say $40 off that 1,200 level. And there is an issue that comes to the equation here, whereby the viability of many of the gold mines globally comes into question with a spot price sub that 1,200 level. Quite frankly, the profitability of those mines really sort of starts to hit the key areas, key levels, and you wouldn't be surprised if any sustained fall below that level would trigger quite a bit of operational shutdowns in the mining sector, the gold mining sector, and I think that could certainly play its part as far as traders are concerned.
We've also seen a notable price reaction in gold and silver now that the US dollar is starting to show some weakness. This has helped once again strengthen the precious metals market. Will it last?
Well, I think when we talk about the strength of the US dollar, I guess we really need to once again look back at the sort of debt purchasing scheme that they have going on at the moment, and effectively the dollar printing that fundamentally happens on the back of that. And I think we're well aware that this 85 billion monthly debt purchasing scheme is likely to start curtailing, if not in December, certainly in 2014. So there will, by default, become less of a negative weighting on the US dollar on the back of that. If we look again at some of the major currency pairs against the US dollar that the global traders look at, I guess the primary one would be the euro. And I think the Eurozone itself has some pretty big hurdles it's going to need to clear in 2014. Certainly, if we look at the inflationary picture over in Europe, that does raise quite a few fears. Also, the fact that the data coming out of France is increasingly weak and does raise the very real possibility of France going back into a recessionary economic stance, and the negative weighting that would place on the rest of the Eurozone and therefore on the euro. And by default, I think that might well see the dollar strengthen on the back of it.
Finally, Alistair, what have you witnessed at your end at IG with regards to gold and silver? And do you have predictions as to how this might play out in the final hours before the Fed policy meeting?
Well, I think if I might start at the tail end of that question, which is the Fed policy next week, my personal opinion here is that it would take a very brave FOMC team to vote in tapering starting in 2013. Certainly the economic data that's being released for America does paint a more convincing picture of an economic environment that could handle their debt purchasing scheme beginning to be reduced. Having said that, though, I think that the psychological effect that this might have on the average man on the street, the negative press that would be pumped out, and the conclusions about equity markets that would be thrown into the equation, could derail the very important retail seasonal sales that we're seeing at the moment. So with that in mindset, and with the U.S. recovery still really being relatively fragile, I see it as unlikely that they're going to start in December, although a possibility certainly, and I think more likely that they might wait until the first quarter of 2014. As far as gold is concerned, I think if we look at the chart, as I've stated, any sustained break below 1200 does bring some big questions in as to physical manufacturing of the precious metal from the miners, the viability of operations, and that could well see the supply side of the equation dramatically reduced. And obviously the negative trend is pointing downwards. We still have a bear trend that gold has been in for certainly the whole of this year, and it's very strongly in place. I think certainly a break above that 50-day moving average, that sort of 1280 level, would need to be seen. But we are coming very much closer to a time whereby it's going to have to break one of those two, either the negative trend that it's been in or that 1200 level.
Okay, that's it from Commodities Corner. Join me tomorrow for the last press review of the trading week. Goodbye.